Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. There you are. Stuart and I are going to be entertaining you and hopefully informing you for the next hour. Welcome to our webinar for November. It's been an incredible month for the portfolio, helped along by the Rand, as you can see from the headline there, that the weaker Rand has driven the portfolio to an all-time high, but we'll get onto that in just a moment. So Stu, as far as you are concerned, did you make a lot of money out of your shareholding in the past month?
Alec, it was good to have the Rand as the sort of safety net in a sense when you look at your offshore portfolio in Rand terms, because while you had a little knock, I mean, it was a one-off the Black Friday sort of discounts, as they call them. You don't really notice as much with that Rand because it generally goes in opposite direction. So it's quite a nice leveler in times of crises or short-term crises. So yeah.
On top of that, our portfolio did very well with the heavyweights having a good month. Unfortunately, 2U continues to disappoint. And I'm sure there's some people listening and saying, damn it, I bought some more 2Us because you're so bullish on them and the share price just keeps going down and down. But I suppose as a warning, you can never really time these things perfectly. And that's the 2U story. And I'm still very confident about it. I've been sent some negative stuff on to you. I've read through it. There was a link to a university in California that was charging $100,000 for social services degrees or social worker degrees. And that was being offered by 2U, and there was a bit of story that went around there. There's quite a big short position, I think, in the company. But when you've got Ray Dalio and Kathy Wood who are in favor, well, the shorts had better watch out.
So I thought they would have learned from Tesla, Alec, the short.
Yeah,
you just never know what's going to happen. So.
I thought we would have learned from Tesla, but anyway. Okay, so let's go through the text, Stu.
Excellent, thanks. Those new to the webinar, there is a control panel on the right-hand side. There's a little high five button on that control panel. If you can see Alec and myself and hear my voice, can you please give us a high five so we know we're coming through loud and clear? Excellent, got some high fives coming through. And as the intro suggests, we do like to keep it conversational. There is a little questions block on that same control panel. If you can please put your question in there while Alec goes through the little presentation, and we'll get to it as soon as possible. But all good this side, Alec.
Brilliant. Let's switch our cameras off, switch the presentation back on, and get ourselves ready for the next hour of discussion. What I try to do is to go through the portfolio, go through the major issues for about half of the time, or a little less if possible, and then we address various questions. But Stu does stop me with the questions as soon as they are available, and please feel free to start putting them on now. We tend in this webinar, because there are quite a lot of people who attend it, to run out of time to address all the questions. So if you do have something that's a real burning issue, please post it as soon as you can. So just an overall there, it is now 7 years. We started in early December 2014. It's now less than a week shy of our starting date, so we can call it 7 years old. The portfolio today, we can call it 7 years old. And as you can see, compound annual growth rates of 21.5% in dollars and 27.7% in rands. I'll get into that in a little bit more detail in a moment, but those are absolutely phenomenal. Warren Buffett, the greatest investor of all time, has managed to do over 20% compound annual growth rate in his Berkshire Hathaway for more than 50 years. So, well, we've got a heck of a long way to go, but the good news is that when you look at this compounding of a portfolio, you get money made on money. And what I'm very excited about is the way that the portfolio has performed over the past year. So it's one of those things that you can do well for a period. And anyone who bought Amazon at $327 will be looking pretty clever today at $3,500. But you need to be able to continue the compound annual growth rate to keep going. And I think that's the one thing about this portfolio that has been unusual. The other thing that we need to talk about is because it's been going for 7 years, there are a lot of people who look at it and say, goodness, I can't participate in this, even though it is a model portfolio. So we are starting a new portfolio next month. Stu, have we got a date yet for it?
We're looking at the 14th of December, Alex, the Tuesday, the last Tuesday before we builders go on leave, as they say. On
the builder holiday.
Yeah.
It's 13th, isn't it?
13th the Monday. So it's
13th Monday. Okay, so we on the 14th, 13th is my lucky number, so I was hoping. So the 14th of December it is, and we'll be coming to you from our new offices.
Definitely, Alec. We should just up the road in Bryanston. I think everyone's very excited for that move.
Yeah, we'll be in Homestead Road, and actually next year we're looking to have in-person webinars. I guess we've got to get Omicron out of the way. It seems everyone's panicking. We heard today that a face-to-face meeting, that a big one that we've been preparing for tomorrow, is now going to be done on Zoom. And there's certain things you can't do on. You've got to do face-to-face. So anyway, but we'll be in our new offices. Hopefully, Clive tells me, and our colleague Clive Eckstein is also our project manager. So that's one of the things he's good at. He says early next week we'll be there. And let's hope that we will be able to bring you the next webinar on the 14th from the new offices. But before that, we've got two webinars tomorrow. So just make a note of those two.
Yes, Alec, we've got the one on the Galilela oil. It's an immune booster with Tim Modise. I'll put the links on the chat in the next while.
And Jeanette, who knows about these things, says it's full on. She wants to buy it already. So put it on there. Is it a cannabis oil?
I'm not 100% sure on the makings of the oil. That's the thing, Alec. But with the way the world has gone, I would assume there is cannabis in the oil. It's sort of a big part of the new sort of movement.
And Jeanette knows all of these new age stuff, so she likes it. One of the panelists is Pali Lekhohla, who's a former Stats SA head. Yeah. So that's on tomorrow at 12, and Tim will be hosting that.
Tim will host that one. And then we've got Orbvest. Like we've got Medical 27, and there's another ODH, the Diversified Holdings number 5, which they launched. So we're chatting to Martin Freeman and Justin Clark at 5 o'clock tomorrow.
All right. So, and that's the one I'm going to be hosting. We have been doing those at lunchtime. The problem is when you live in New York in winter, to get to us at lunchtime means a very early start. So we're going to try something different tomorrow, and we're going to do a 5 o'clock with Orbvest. I know they're always incredibly well supported, and will you also put that on the chat channel? So you can sign up for both of those webinars now for tomorrow. One at noon, which is really, really interesting, unusual, and then the other one is Orbvest. I know there's a legion of supporters who will be on this webinar as well, and you can click on that too. Okay, so much for the formalities. All the tech's working.
All good, Alex.
Stuart's sitting opposite me, so he can actually take me off if I start saying the wrong things. And let's get into the portfolio. Here's the big story: the rand dropped 9% in November. Another one of our partners, EasySoft, you can see their software, and I'll recommend this as well if you're looking for any computer software or share market software. The technical analysis tools are better than anything I've seen anywhere else. And it's been going for, Adrian Morris has been at this for 30, 40 years. So the database is amazing. But have a look at this graph, and you can see the moving average. I use a 21-day moving average. That's the red. And the black line is the actual rand against the dollar. Remember, it's inverted. So when the rand is at 13.50, that means it costs you 13.50 rand to buy $1. So that's stronger than where we are at the moment, which is around 16 or just over 16 rand to the dollar. But in the last month, it's dropped 9%. It's gone from 14 rand in the late 14s, 14.80 to around 16.15, round about there. This was last night's close at 16.12. And that has had a dramatic impact on the portfolio, as you'll see in a moment. But what is interesting here is that we bought into the story that South Africa's economy was being poorly managed by the ANC. That's when we started this portfolio in, can you believe it, in 2014, right in the middle of the Zuma era. And the idea was that you could either take your money offshore and put it into cash, into US dollars, or you could invest it in equities that we would do our best to find the right kind of equities. And in particular, we focused on exponential equities. So that's really the strategy behind the portfolio. We started off very conservatively 7 years ago. The idea was to put about half of the portfolio either in the S&P 500 index, so you were just tracking the US market as a whole, and the Berkshire Hathaway share price shares, which was a proxy for the S&P 500, and then to have a spread of wild cards, as we called them. There were 5 stocks that we put 8% into each. So you had 60%, 30% in Berkshire, 30% in the S&P 500 index, and then another 5 shares, and those 5 shares were 8% each. And then over the time, as the portfolio has evolved, and as some of those wild cards have done very, very well, we have outperformed considerably the just pure exchange rate play. And that is, I guess, through the focus on exponential shares, and sometimes being fortunate enough to get out of shares at the right time. Of course, we were also very famously getting out of shares at the wrong time. And I don't want to say Tesla again, but Warren Buffett tells me I have to do this. He says, trumpet your losses and be very quiet about your victories. And one of our losses was in 2018, when Elon Musk seemed to be going nuts, fighting with the SEC, putting out tweets to say that the company had been sold, and etc. It was just a little bit too difficult to sleep with a Tesla shareholding in your portfolio. And so we decided to sell out. And of course, Elon and his army of supporters have proved us to be very, very wrong. And that was a sale that, well, I did sleep better at night, but now I suppose it's a little bit like a baby. You cry about what could have been missed, but you should never do that in investing. Never, ever. You make your decision, have your commitment, stick with it. And that was the story with Tesla, which we sold at around $330 rather a share, and that was before the split, and it's now whatever, $900, somewhere around there.
It's almost 1,200 now, I think, or 1,100.
Well, there we go. So as you can see, I've got a blind spot there, got my blinkers on. The other one that we didn't do well on was having bought into Cloudflare, which is an amazing company. I love that company. We use it ourselves. It's the biggest security player for the internet. And we bought into Cloudflare. It's listed as net. That's the shortage of it, short version. And we bought in there in the 20s, $20 at March last year, when you had the collapse of share prices because of COVID, of the initial COVID. And then the consequence of that was that the net, we held on to it. It had trebled in a very short period of time. There were worries and concerns being expressed all over the place that maybe emerging tech stocks, which Cloudflare is one of them, had gone too fast. We bought the story, unfortunately, and sold in the 60s, and it's now sitting just under 200. So those are the two that show sometimes you got to stick with your principles, and your principles on this portfolio is that you buy shares to hold for an average period of, Stu?
Forever, Alec.
There we go. Okay, so Warren Buffett says when you buy a share, your average holding period is forever, and that's Tesla and Cloudflare are there to remind us of that. We've been fortunate with some of the other sales, but that's not the purpose of this discussion. It's more a question of think very carefully before you buy a share, do your homework, know what the fundamentals are, and then ride it. And don't get off that horse until something structural has happened or something fundamental has happened in the business. So here we go. the fundamental thing for us here is to invest offshore unless there are unusual opportunities in the South African market, and we've taken advantage of some of those as well, as long-term participants in this portfolio will recall, with Sasol, for instance, which you bought at 28 Rand and sold at 145. But it is that kind of a portfolio where we are playing the Rand, and we are taking a view that the Rand over time will weaken. In the past month, it re-emphasized the wisdom of that strategy.
Just on Tesla, Alec, David says, in my humble opinion, Tesla at a PE of 350 is way overvalued. I'd be very careful. High PEs of 2030 are already in overvalued territory. I'm not a shareholder at the moment. I have other kinds of asset, but well done on what you've done.
Thank you very much, David. My worry about that philosophy, though, is that exponential companies do not respect PE ratios. They just don't care about PE ratios. And you take a business like ours at BizNews. So we're profitable and we're growing fast. And so what do? Do we want to maximize profit, or do we want to maximize growth? Well, we want to maximize growth. So we are reinvesting everything we possibly can into the business. So and that means that you invest in something so that your profitability will come under pressure, relatively speaking, because you're spending more money on new developments. So in a tiny way, what we do here at BizNews is what exponential companies do internationally. And I would really urge you to be very cautious about valuing them on PE ratios. Much better to have a look. Can they grow exponentially? Will they continue to grow 20% plus? And I'll show you something in just a moment. Look at this graph in front of us. Now, this is the Rand graph. And as you can see, the last month we had a really, really good month. But there were a few months recently where the portfolio, because of the strength of the Rand, was actually down. In August 2021, we were down on August 2020. However, by sticking with what we had, the Rand is reversed. And you go year on year, November 21 to November 20, and the portfolio is up 24%. So in the investment business, just be careful about having knee-jerk reactions like the world has done to this Omicron. No knee-jerk reactions, and you will enjoy the ride for the long term. And there's a wonderful graph for you. Clearly, 2020 versus 2019, the return of the portfolio was extraordinary. And you can see there that when the pandemic hit us in March 2020, the value of this portfolio subsequent to that has doubled, has virtually doubled, not quite, but virtually doubled. And this is a portfolio that started with 2.4 million Rand 7 years ago. So it just shows you the power of compounding. It's now over 12 million Rand, as you can see there.
Just on the Rand, Alec, David says, I've lived back in South Africa since 1995, and it looks like the Rand halves every 10 years.
That's an interesting rule of thumb. Well, maybe that's something then just to put into the back of your mind, because if we go into that, look at that Rand, it blew out in 2020 with, as you can see, at the same time as the COVID pandemic hit the world and the world went into lockdowns, the Rand blew out from 14 to 19. And that's the problem when you're living in a country that's 0.5% of global GDP. You're like a cork on the ocean. And if the ocean gets big swells or if it gets big waves, your little cork gets thrown around like crazy. And at the moment, with the Omicron coming through and concerns now that we're going to have another wave, another new wave of the pandemic, you can see what's happened to the Rand as a consequence of that. So we were stabilizing quite nicely, in fact, for much of this year, 2021, and now it's going the other way. Anyway, I think it's very difficult to call anything, any currency, any investment indeed, but what one might do as far as the Rand is concerned is to realize that we are a price taker rather than a price maker. And that's just a simple function of an economy that is tiny relative to the rest of the world, and one that horribly underperforms relative to the rest of the world as well. We've actually gone backwards in the last 10 years on a GDP per capita basis. So there are all of those issues. who knows, maybe if you go and listen to that interview that I had with Yaki Celia, he reckons that and he's been calling this very, very well. He's a scenario planner, the head of the Institute for Security Studies. And he, in his book, Fate of the Nation, gave various scenarios. And the most positive scenario was where the ANC went below 50% of the national vote and then had to do a coalition with a business-friendly, I would call economically literate political party. Presumably in this instance is the DA, might even be Action SA, who knows. Lots of things happen in politics, even though Herman Mashaba says he'll never, ever work with the ANC. But when they get to that point and you start losing the ideology and start embracing the economic sense, who knows what could happen to South Africa and the economy. But my goodness, we can't keep on in another decade the way we've done it in the last decade, and we're seeing the result of that. Okay, moving on to US dollars. As you can see, year on year, 20% increase in US dollars. That's phenomenal. And we're also at an all-time high there, remembering that this portfolio started at $200,000 7 years ago this week, and we're now heading above $750,000. So that's the power of compounding. It's extraordinary if you can get your savings to grow at 20% a year, because that's what the portfolios have done. This one's done 21.5% a year. You go from 200,000 to 750,000 in 7 years. It's a reality. Big holdings shine in November. You can see there of our big movers, Microsoft, Apple, and Amazon, all up by more than 7% in the month. Purple continues to run. That's not a big holding, but it has become a big holding because of the incredible performance that it's put on in a very short period of time for us. Wilson Bailey flatlined in the months, didn't do anything. And there's poor old 2U down the bottom of the charts. You see Zero down by 9.5% in the month. And that is directly a result of the Aussie dollar losing ground against the US dollar, in the same way as the South African rand lost ground against the US dollar, the Aussie dollar as well, and Zero is listed in Australia. So in Australian dollars, it's held pretty steady. However, in US dollars, there's been an impact there. But look at the bottom of the chart, and this is what really excites me when I look at the performance. In rand terms, the portfolio was up just under 11% in the month. That's incredible, to almost 12.5 million rands. At the bottom, you see the JSE All Share Index also had a good month, 4.5%, but the portfolio outperformed it primarily because of the offshore element. And there, even on the offshore side, we did a little better in US dollars in the S&P 500 index. And that was due to Microsoft, Apple, and Amazon outperforming the S&P 500 index, as you can see there. So although we had a laggard in 2U and the decline by Zero because of the US dollar factor, the portfolio overall outperformed. And that gives you the understanding of the power of diversification. Now, diversification in Warren Buffett's terms is you have a number of eggs and you put them in a basket and you watch the basket very closely. Not this abdicating idea that many money managers have, where they have 50 or 100 shares in their portfolio. That's over diversification. How can you possibly understand all of those companies as well as you could if you had, say, 10? And as you can see in our case, that's well, on this lot we have 9, and then you can add Avenge, which we added last month, which was a special situation. It's 6 cents, which we bought in at. It's still trading there. That's fine. I went into some detail on Avenge when we purchased it last month, so I won't be beating that drum too hard today.
Like I know in the management world, they say no one should manage more than 8 people. So I suppose the stock's a similar ratio, as you said, 8 to 10 is probably a good bet.
I never thought of that, but that's, of course, Malcolm Gladwell,
Gladwell.
In his research has explained that, and we certainly try to do that at BizNews as well, is that when we go more than 8 people in one operation, you try to halve that off into a team of 8. It's been shown that 8 is like the maximum number, and I've sat on boards and committees when I had a period in corporates where there's 30 people on the committee. and nothing ever got done because it was impossible for the chairman, as good as they might have been, to manage that number of people. I've sat on a board, a public company board of 20 people. And it was the same thing. There were 3 guys who actually ran the whole thing. And you could see that. And everybody else sat there, didn't get a chance to put in a word edgeways because they weren't kept up to date as closely as they could have. Anyway, so it's a very interesting point that. 8 shares, well, we're at 10. I'm happy with 10, where we are right now. But when you start getting to 50 or 60, you're not diversifying.
I think you'll miss out on the lose. You know, you can't track them all, so you might miss out, and things could just either way, up or down.
Yeah, well, you look at a 2U down 25% in the past month. So what do you do about that? If it's 1% or 0.5% of your portfolio, well, why bother? In our portfolio, it's 2% of our portfolio. So it's a very, very small holding, but it's more than a why bother. It's 1/50th, I suppose. Oh, okay, I'm trying to justify it. There we go. But we had 7 very good years. And really, just to reiterate here, often we've put stocks in the portfolio and they have underperformed. In fact, that's more the norm, that we put a stock in, it goes nowhere or goes down and really looks horrible for a period of time. I remember buying Apple at 125, 130, and 140, doubling up at 120, and it got down to 90. And you look at that and you think, oh my goodness, what are you doing this for? Of course, today it was a good idea. But the point is, whenever you buy any stock or you become a co-owner of that company, the idea has to be that you're going to be a co-owner for the rest of your life. And with 2U, I'm quite happy with that. Okay, so here we are. The Rand dollar starting point was 11.27. It's now 16 Rand 13. If we'd started on the 5th of December 2014 and you'd said to me that the Rand would depreciate from 11 Rand 27 where you were to around 16 Rand 7 years later, I thought, yeah, that's about right. That's about right. That's about what we were thinking at the time. We thought that it would depreciate. If you'd said it would go to 25, which I guess some people at the time were predicting, you'd hope so, but if you were invested offshore, but actually you didn't really hope so. So this from 11 to 16, that's about in the range of what we would have thought on the 5th of December. If you'd said that the stocks that you own would grow by 21.5% in US dollar terms, I'd have said, you crazy. That's far too high. If we could make 5 to 7% above the depreciation of the Rand, then we'd be doing real well. And you look at that at the bottom, the compounded average growth rate of the dollar against the Rand in the last 7 years, it's very easy to calculate, 27.7 minus 21.5, that's 6.2%. So 6.2, if you could have got like another 7 or 8% on top of that, so you'd be talking about doubling the benefit of the Rand, I think you'd have bought it in December 2014. So when we look back and we see 21.5% in dollars, and rather than say 7 or 8, and 28% in Rand, how's that been achieved? It's been achieved through a lot of good luck. Amazon has been a big reason for that, but so is Microsoft and so is Apple. The exponential companies, the idea of investing in exponential companies, and of course, holding our nerve at the time that the COVID disaster hit South Africa and buying in some companies at the very, very bottom or very close to the bottom. Discovery at 60 Rand, selling at 120. Sasol 28 Rand, selling at 140. That kind of a thing has served us very well.
Alec, just on 2U, David asked, it seems like he's the only one sending questions, and he says, with the 2U, with it down so much, is it not an opportunity to buy more stock if you believe in the future of the company?
I agree. It is an opportunity. Why haven't I done it then? Why have we not added more 2U to the portfolio this month? The reason is that I'm keeping a little bit dry. I'm looking at Uber. I really like Uber. I think that Uber's a better play perhaps than 2U. I haven't finished my research. So 2U, we're in there. It's a good long-term bet. It's a small company, relatively speaking. If you consider that the market cap of 2U is relative to the others that we have in the portfolio, it's really fractional. I'm just picking it up for you in a minute. So it's like a couple of billion. Sorry, not even. It's $1.7 billion. $1.7 billion. Against that, Amazon is $1.8 trillion. So 1,000 times bigger. Netflix is $300 billion in market cap. So 2U is a very, very small share relative to the market as a whole. Sometimes they can outperform. If somebody picks it up and you get a little bit of wind from behind, it can go very aggressively. So I'm quite happy that we've got sufficient invested there. Have a look at this on your screen now. I keep a track of the compound annual growth rate every month. And so far this year started off real well, as you'd be aware, because 2020 was a very good year for shares after the sell-off that you had in the first 3 months. And so when you go back a year, 24% compounded on the left-hand side is in US dollars, and in rands 30.4%. So that we started well. And then you go down the table and we've managed to maintain around 21% compound growth rate in US dollar terms throughout the year, which is, it takes some doing given that you're coming off such a high base. On the rand side, we're now at 27.7%. This, of course, all goes back to the 7-year starting point. That's a very handsome return. But I think the important thing about this portfolio is you can rest on your laurels. You could have, at the beginning of the year, sold everything out and just sat on cash. And then for the next 4 or 5 years, looked very clever because you had a big fat hump to feed off of the performance of the past. But that doesn't help the people who are only now starting to use it as a model portfolio and to start following the investments that you're making. And as a consequence of that, we'll be continuing with this portfolio into the future, although we're starting a new one on the 14th of December. As promised, we'll be putting $10,000 into that. So if you've got 150,000 Rand and you want to invest in the new look portfolio, which starts on the 14th, just keep that handy, and we'll be giving you a new look portfolio then. But that doesn't mean that we're going to close the web trader portfolio. We'll continue with this for the more sophisticated investors, and also for those people who've actually ridden this horse from the beginning. But interesting to see the compound annual growth rate continuing very well through the year.
Just on the rand, Alec, Tion says, is it not a great? It's not a great time to buy dollars considering where the rand is at the moment. Is it a good time to sort of put money offshore to invest into 2U, etc.?
Yeah, it's always an impossible question, that, because what we do when we buy shares offshore is that we will stagger it over 3 months. So if you want to buy 2U, rather buy your first tranche now, and you'll be paying 16 Rand, 11, 12, around about that for each dollar. In a month's time, you buy your second tranche, and in a month thereafter, you buy your third tranche. So that's really the way that we've invested throughout when we've bought offshore. The reason being that sitting in Rand and being so volatile in Rand, you just don't know. As things stand right now, it looks like the Rand is now turned around and it's going to get weaker for a while. But who knows? We could have the rest of the world looking at South Africa and saying, goodness, but you fellows handled Omicron very well, much better than everybody else in the world, which is my personal opinion right now. So we should strengthen your currency. We should buy into your currency because you actually know what you're doing. On that, we might know what we're doing. I'm not so sure about the broader economic policies, but we're going in the right direction in this young democracy of ours. I truly believe that. However, is the Rand likely to appreciate in the short term? If you were to take a guess on that, you're going to guess wrong. So whenever you buy a stock in the international markets, the best approach is not to take a double bet. You're already taking a bet by buying in at the current share price of the stock that you're acquiring. To then add another layer of risk by taking a view on the rand at that point is just a little bit too sharp for me. So my suggestion is anything that you buy offshore, stagger it over 3 installments. Okay, here's the portfolio. Stu's going to get bored just now if we don't get any more questions through, but that doesn't matter. We'll have an easy night, quick knockoff. Here's the portfolio. You can see in the last 7 years, Amazon has been our absolute winner, almost a 10-bagger in dollars. And it has been, in fact, it is a 10-bagger in dollars. Here we go, 186%, $327 to $3,500. Amazing. And we started with Amazon. So thank you, Amazon. Whatever possessed me to put it in the portfolio when we began on the 5th of December, 2014. I'd like more of that, please. And then Apple, which we bought in at a couple of times. You can see the historic cost price there, because there was a 5-for-1 split, was at 31.16. Was it, sorry, a 4-for-1 split? You had a 4-for-1 split, which means if you want to get the at the time we bought in around $120 odd, but because you've got 4 times as many shares now after the split, it $31 to $160. My goodness. And Microsoft has been the big surprise for me personally in the way that that's performed. But if you get those big 3, as you can see, there's 56% of the portfolio in the big 3. If they perform as they've done in the past month, then the portfolio as a whole performs. The other one that's done really well, and it's a relatively late addition to the portfolio, only coming in September 2019, is Netflix. We've then added Avenge, which was the biggest single purchase that we've made on a one-off basis, and that came in at 6 cents. I know there are a lot of people who've put in their purchases for Avenge at 5 cents, and that's a smart approach. That's a smart approach if you're a private investor, because the share price does bounce between 5 and 6 at the moment, which is a 20% change. So if you're wanting to acquire Avenge shares, and I know those who I know at least one person who follows this portfolio, also called David, who put in his bid in Avenge in October, on the 26th of October, but not at 6 cents, which we bought in at this portfolio, because you can't try and say that you would have got the shares at 5 cents. There's a lot of people in front of you in the queue. But he put in his order and it was settled last week. So he's in at 20% better price than we are. So as a private investor, if you're looking to follow us into Avenge, you can either do what we did, buy it at 6 cents, or you could put in your bid and just wait for a while. I'm not sure you're going to get it before mid-December, when this gets consolidated. All those shares go down from 15 million. We'll end up with about 300,000 shares. And by consolidating, you won't have this huge jump in the share price just by a 1 cent move. But it is an option, maybe up until mid-December, by putting in your bid and just waiting for it to be closed out. I hope all of that makes a lot of sense.
Alec, I'm not sure what they call it, the Avenge, because apparently that share is getting consolidated next week. So would that change the...
Yes, it is going to change everything. Where we'll probably see is that the shares will settle somewhere between the current 5 cents and the current 6 cents, which is a 20% gap. So somewhere between there, it'll probably settle there. But the good news is that it's going to then attract institutional investors, because at the moment, an institutional investor can't go in there and pay 6 cents, and then next month the share price is at 5 cents, and they've lost 20% on their holding, and the people who entrust money to them are going to be pretty cross with them for doing that. So for an institutional fund manager, they'll probably wait. Most of them will wait until Avenge is being consolidated, and once it's consolidated, then the share price movements on a day aren't going to be 20%. They'll be 1 or 2%, as you have with most stocks. So if you want to wait, we decided not to wait in October. We decided to make the investment, and we'll see what goes from there. And the reason for making the investment, as we articulated last month, was there's a lot of reasons. There's a lot of good news coming out of Aveng, and amongst them, when you go back to the PEs, it's sitting at a price to earnings of about 4. So you are really, really buying this one in cheap. Very happy with Aveng, even though we spent 900,000 of the portfolio's money in getting the stake, accumulating the stake that we have. The other big mover in the portfolio that I've been obviously incredibly delighted by is Purple Capital. The reason we went into, sorry, it's called Purple Group now. The reason we went into Purple Group is because this is one of the few exponential companies that you've got on the JSE. And it is providing, it's really delivering the goods. The purchase price of R1.33 is a little late to the party. There were lots of people who bought a few months earlier at 80 cents. And there were the very lucky people who bought in the 30s a couple of years ago, or a few years ago. But the story, when we bought in at 1.33, was on the basis of financial results to the end of February, and that was the interim results. Those showed that it's really on track. For the final 6 months of the financial year to the end of August this year, the exponentiality accelerated at Purple Group, which is the owner of Easy Equities. That's the primary investment they have. And they also picked up a massive gain from a partnership that they created in what is now called Easy Crypto. And that from giving the partners, they're the entrepreneurs on Easy Crypto, access to the Easy Equities community, which is now just about 1 million accounts that's been opened. I think it's over 500,000 anyway, a very active, 600,000-700,000 is the number. That has given them, that has added 50 million rands to the Purple Capital value. Now, when you're looking at the market cap of Purple today, which is sitting at 2.6 billion rand, then 50 million is not that much. And that shows you as well that it is a investment or the potential more than that of the partnerships that can be leveraged off the base that Purple has created. And the big story there, when you read through the annual report, is that because they're so innovative, because they market to their existing community, the vast majority of the new accounts that are being opened at Purple are from existing account holders. So they get incentivized, it's 50 Rand a new account, to get their friends and family to open accounts as well. And if you've got a good product and you've got that kind of incentivization, you really do have a powerful vehicle. And the exponentiality that we've seen on Purple Capital is certainly, in my opinion, only at the early stages.
They've got a retail base of what, 59,000 investors, Alec, as well. So there's a lot of
people who've actually put money, just cash money in with them. Yeah, 30, I think it was 30 odd billion rand in deposits that they're sitting on, just cash deposits. It's a phenomenon. It's an incredible story, and well, it's one that's been going for about 7 or 8 years as well. Imagine if we'd put Purple into the portfolio. I think it was in like 3 or 4 cents back then when we started this portfolio, but that wouldn't have enabled you to sleep very well at night had we done that. Now's the time to investing as well. You can win, you can get those big wins by sometimes being incredibly lucky, but by the same token, investing is about buying the stock forever and going to bed at night and putting your head on the pillow and not worrying that you are going to be waking up crying or anxious. You just want to be able to go to sleep knowing that you've done your homework and they're moving in the right direction.
Alex, Harry just wants to know, he says the $1 trillion infrastructure bill has been passed in the US. Would you consider investing directly into companies that would potentially benefit from such an investment? He mentions US Steel, John Deere, etc.
You know, when politicians start interfering in the market process, it worries me, as it should worry everybody. And that's exactly what the politicians are doing there. They have, think of this, just think of it rationally. So we had the global financial crisis in 2008. And to get out of the global financial crisis, the United States started creating money out of thin air. It's called quantitative easing, which is a bit like Eskom calling blackouts load shedding. It's the same thing. It means blackouts. Load shedding sounds very, very nice, but actually, if you've got no electricity for hours in the day, it's a blackout. In the same thing in the United States, if you can call it quantitative easing, but if you're creating money out of thin air, that is creating money out of thin air. That's exactly what it is. Now, maybe you get away with that if you're the world's reserve currency for longer than a country like Zimbabwe, which can't get away with it at all. And we've seen that anybody who's been to Zimbabwe anytime in the last decade will have bought a few souvenir banknotes, which says $100 billion. That's what happens when things inflate. The big issue right now is inflation. It's the thing that, if you read the premium newsletter, I'm banging on about it. Any information that's coming out of that is worth or important that we pay attention to, keep putting that onto those stories. Inflation is a dreadful monster that wipes out the value of your investments. But if you're a government and you've borrowed as to the degree that the United States government and many of the Western country governments have been doing since 2008, they've been creating more money out of thin air. They've been doing this quantitative easing. It's still going on. It hasn't stopped yet. They're talking about the tapering it off. And when they taper it off, then interest rates will then realign, etc. But if you continue to do that, you are putting yourself and those people who rely on the value of their assets at risk, because if it inflates, the value of their assets decline, and particularly those people who are living on fixed incomes. I know exactly that. I've been looking at a family member who bought and living annuities, they called, 25 years ago. And the amount that he bought, gave him 320 Rand a month. And that 320 Rand today is worth like about 20 Rand. It's just crazy. So in the same way as we have the compound growth rates, as we've seen in this portfolio, which go in the right way, when you have high inflation or even moderate inflation, as we had in South Africa, you have the depreciation or the destruction of wealth, which goes the other way. Now, those moderate inflation rates that we've seen here are starting to catch hold in the United States, China, UK, Europe, and there has to be some consequence of quantitative easing. So take it one step further to the original question, which is on infrastructure spend. Somebody has to pay for that infrastructure spend at some point in time, and the somebody who has to pay for that is the taxpayer or inflation. So the only way you get rid of debt in a government is by reflating, because you're sitting with fixed amount of debt, but if it's depreciating by 5% or 10% a year because of inflation, then it's much easier to service. Or if you can't do that, if you've got no inflation, then how are you going to repay that debt? Well, you're going to have to tax people higher. And neither of those things, inflation or tax, is good for the economy. So sure, in theory, these economically illiterate politicians are saying that they're going to spend more money on infrastructure after spending billions, trillions, not billions, trillions, bailing out US businesses, many of whom didn't need bailing out. I have a good friend who has a significant business in the United States, and he said it's been such a pleasure. He's just been sent checks every month to keep people employed. And he said, but we're busy. In the sector we're in, we're busy. So, and that's the problem. If you're sitting in Washington and you're trying to use a blunt object, you're going to make a lot of mistakes, and you're going to pay for those in time. And that's the thing that bothers me as well about any politician. They will sit in their blue light brigaded ivory towers and make decisions based on the best guesses, but not decisions based on being plugged in to what is happening to people on the ground. And that's why the best thing to do is to rely on the private sector, have a look at the companies that you can trust, that don't need government assistance, that don't need support from legislated monopolies or legislated profitabilities. I remember in this country, I had intense frustration. You'll recall that both in my previous business and in this business, we have had to compete with in the audio side with legislated monopolies. And I've approached the people at ICASA and said, but why are you guys restricting the number of licenses? This is crazy. You should make a free market, make it competitive, and the consumer will benefit. And people who are outside of the tent will be able to come in and hopefully do a better job. At the time, radios in South Africa, radio stations in South Africa were running at EBITDA margins of 50%. I kid you not, 50% plus. And of course, the radio stations thought they were genius managers. In fact, if you've got a legislated monopoly, you just print money. ICASA told me at the time that they legislated for success. So they didn't ever want to see a radio station going bankrupt. They wanted to be sure that every radio license that they issued, that whoever got that license would make a lot of money out of it. Well, that hasn't really helped them, as you've seen recently. Classic FM's gone bang. There are a heck of a lot of other stations who are just teetering on the edge there, because eventually it's like SAA or like Eskom or like Transnet. You can't keep feeding the monster, because the monster gets fat and lazy, and unfortunately, the market system, or just pure logic, tells you that they are going to that you're sowing the seeds of destruction. It's like overfeeding an animal or a racehorse. The horse can't race anymore if it's too fat. It hasn't been exercising enough. Similar thing of what's happened there. So I would be very cautious about companies that benefit from a short-term stimulant that a government provides. Rather go for a company that's benefiting because of the human ingenuity that exists within that organization.
I suppose that you can't put broad brushstrokes over a world of individuals anymore, Alec. Everyone's got their own challenges and opportunities, and you can't just say blanket, you get this, you get that. You've got to actually look at the individual cases now. It's a big change in government thinking. It's got more localized and stuff.
In our thinking too, as individuals, as human beings, we now have the internet. We now have information. When you go back to the Industrial Revolution and the great fortunes that were made there, it was not what you knew, it was who you knew. And much of for instance, in the banking field, bankers in those times had better information than the rest of the public, so they could profit from that. And the best example was the Battle of Waterloo, where the Rothschilds made their fortune through carrier pigeons that flew over to London, because it was thought that Napoleon was going to win that. All the odds were in Napoleon's favor at the Battle of Waterloo. But when the carrier pigeons came over to the Rothschilds in London, they went and bought the bonds, in other words, British debt, at a fraction of their net value, because the thinking in the City of London at the time was that Wellington was going to lose. So that was information. But that information now is instantaneous. It is something that we all in the same boat when it comes to receiving information. And that is why individual investors can compete with institutions. If you just apply your mind a little bit, apply Warren Buffett's principles, don't get emotional and sell when everybody else is panicking and running for the hills. There is no reason whatsoever for you to underperform a big institution that's got a huge infrastructure cost and very expensive staff. than if you just do it right on your own basis. So the world has changed, Stu, and we've been empowered. Human beings have been empowered.
I think it's across all the sectors as well. Like if you look at education, I mean, I know we look at 2U, but if you look at things like YouTube, if you have the ability, you can source what you need at any given point of time now. You know, if back changing a plug as an example, before who would have done it for you? Now you sort of go and look at what color goes where, etc., etc. And it starts as simple, but it obviously builds on top of that.
I thought you were like me and blew out a few through my Scale Electric. I remember that putting the wrong color into plugs and then not having a Scale Electric set anymore. That was a major disaster. But you're so right. Today you can go online and learn just about anything. You can get these the MOOCs they called, and that's where 2U is done the deal with Harvard and MIT, and they now own the MOOC of Harvard and MIT. And imagine you bring Stuart in to learn something for free. It's called edX, is the company that Harvard and MIT put together. Stuart comes in, he learns something for free, and then he gets the bug and he wants to learn more and he wants to pay for something. And that's where 2U's cost of acquisition falls through the floor. Where's the success story of Easy Equities? Cost of acquisition, 50 Rand a person. What's the cost of acquisition for a financial services company? 1,200 Rand. So suddenly you can see the benefits there. And it is a new world. And we just need to open our minds and find the companies whose minds are open rather than those who are heavily invested in the old ways of doing things.
Sure, Alec, it's almost our hour is almost up, but I think there's a nice question from Sean, maybe to finish off on. He says, what future technology excites you the most for potential investment going forward?
Sean, yeah. I don't know. I just don't know. What I do understand is that our own industry, our own business is media is at the infancy still of being able of what exists into the future. And what I mean by that was when you consider that you have a producer of a product or a service over here on the right-hand side, and then imagine you stretch your arm out and you then have the consumer of that product on the left-hand side. In between, at the moment, you have intermediaries, and there are any number of intermediaries that take their little bites out, so that if you're a farmer producing eggs, eventually when those eggs get to the consumer who buys them in Woolies, they're paying a multiple of what the farmer is receiving. I put that into the virtual world where it's not eggs that you're delivering, but something that you can package and transmit and deliver in that way. And when you think that one through, that you've got the same intermediaries as you would have from the egg farmer to the Woolies person who buys in the retail, and those intermediaries don't actually need to be there when you have perfect information that's available to the whole community. You can see what the opportunity is. So I heard it described somewhere where it was spoken about is what is your potential market? What is the potential market? And that's why I'm looking at Uber, because Uber's potential market is everybody who has a car or drives a car or wants to get takeaways delivered to them. That's Uber's market at the moment. The total addressable market of Uber runs into literally billions of people. But what about if Uber says, no, that's fine, but we've got these guys driving around the roads. Why don't we deliver other stuff as well? If the Uber driver is going to be driving from Johannesburg or the south of Johannesburg to the north of Johannesburg, why shouldn't they pick up a package that they can drop off somewhere along the road? And it doesn't have to be a package, it can be all kinds of things, not just eats. And that's where I'm looking at people where the total addressable market is massive and there are many intermediaries involved there. And when you apply your mind, when you reflect on it, when you meditate on these things, you will find that there are lots of those opportunities. So from a broader base, from a broader perspective, I can't say to you it's steel or it's retail or it's many of these old economy ideas that we have. It's where you can use this explosion of information that has given us put us on the same basis as the Rothschilds were in, what was it, 1816, 1814, anyway, early 1800s. In the early 1800s, the Rothschilds had the carrier pigeons and the people watching the Battle of Waterloo, and they could profit from it. Today, the Rothschilds don't profit from it. We're all on the same basis. And I believe that human beings pretty much are as smart as each other. We've all been made the same way. We've all got the same brains. And if we can just open our minds and tap into the information that's available and learn, and you take advantage of that by learning, then we will be able to build a better future for ourselves. And those companies who actually understand that are the ones we need to be driving into: the Netflixes, the Amazons, the Spotifys. And I believe the 2Us, although the 2Us certainly trying my patience at the moment, toying with my emotions.
Excellent. Thanks, Alec. I think it's a lovely way to end this webinar. I think next on 14 December for investors.
Yeah, 14 December for this one. Don't forget, tomorrow we've got one at noon.
That's the Galele. I put both the registrations links on the chat channel. The Galele is at 12, and then Orbvest at 5 p.m. with yourself.
Yeah, and the one at noon is with Tim Modise. So it's really interesting. And then Orbvest at 5 o'clock tomorrow afternoon. Orbvest is it's like the other side of your investment portfolio. You want to be offshore. We know that. Here's in equities. There you want to have a good income stream, and that's the Orbvest. And have our BizNews community members, and they just keep singing the praises of Orbvest, because it's been some years now that we've been partnering with Orbvest.
3-4 years, I
think. 3-4 years, and continuously those who've invested in those 3-4 years, as the rand has been bouncing around. The right time, of course, would have been if you just go back to June, as recently as June, you could have bought in under 14 rand to the US dollar. Now you're going to have to pay 16. But it's, again, if you'd go back a couple of years, you'd have been paying 19. So it's never easy to say what's the right time to take money offshore. And if you speak to Magnus Haystack, he'll say anytime. Okay, so that's it for this webinar for today. Thanks for being with us. From Stuart and I, Alec Hogg. Look forward to the next time. Bye-bye. Thank you for joining us for this webinar, which is compiled and produced by the team at BizNews.com. A recording of this webinar will be available later today on the BizNews.com channel on YouTube. From our team, until the next time, cheerio.